G'day folks, welcome back to a weekend wrap of the S&P500 and the NASDAQ. Now the chart is showing a potential bearish breakout to the downside, so just be cautious about going long. We're also going to very quickly touch on crude oil. We've covered that in yesterday's video, so reference that if you need to get more detail, but I'll quickly cover it. So we'll include backtesting as well, which demonstrates how you could have traded using one of the two strategies we often show. So don't forget to hit that like and subscribe button to support the channel. So as of the outlook today, June 4th, the market reaction to the Middle East tensions, the recent escalation between Israel and Iran, including Israeli airstrikes on Iranian military and nuclear sites, has heightened geopolitical risks, leading to increased market volatility. Oil price surge and inflation concerns. Brent crude oil prices spiked over 10% before settling with a 5.7% daily gain, reaching $73.29 per barrel. This surge raises fears of stagflationary shock, complicating monetary policy decisions. Stock market declines. The S&P fell by 1.1% to 5976, and the NASDAQ dropped by 1.3% to 19406 on June 13, erasing weekly gains. Investor anxiety over potential disruptions to oil flow and economic instability contributed to the downturn. Sector-specific impacts. Airline stocks plummeted due to rising fuel costs and regional airspace closures, while defense equities and gold climbed as investors sought safe haven assets. Energy stocks performance. Oil-related companies like Chevron, Diamondback Energy and Devon Energy saw significant gains, reflecting investor interest in energy sectors amid rising oil prices. Investor sentiment and outlook. While markets have shown resilience, analysts caution that prolonged conflict could lead to sustained market volatility and economic repercussions. So we always look at the trends. So for the S&P on the monthly, you can see the price is still above the moving averages, giving us a somewhat pretty strong bullish momentum. On the CCI, though, it's actually fallen below the moving averages. So that's a weakening signal, and that was a result of, if I zoom out, that was a result of this just bearish divergence back here. Lower highs on the CCI versus higher highs on the price. That actually broke down with the wick of that candle in that month and hit that minimum 23-38% Fibonacci range. We had another bearish divergence back here, longer term. You can see these have been a very long-term play. That broke down as well, hit our target area. Now, one thing I want you to notice as well is I've marked this area in red, and that's basically these fair value gaps that haven't been filled with orders. So these ones up here were filled. If I zoom in, those ones up there were filled with the wicks of these candles, especially that wick of that candle there in April this year. But these ones down here haven't been filled yet. So just be mindful of that. If we see a downturn, a strong downturn in the market, we're very likely going to see the price to at the very least hit this area. So just be aware of that. Not saying it's going to happen next month, but just be aware that if the market does take a dive, especially below these moving averages, we'll likely see it reach this area as well. That's the monthly. Now on the weekly, we had at the moment still showing bullish momentum. The CCI has broken higher, and so is the price. And again, I've got another little fair value gap that's been identified there. We had a few divergence back here that have played out, and also those fair value gaps have also been filled, especially with this price action here. Even those ones there with that bullish movement there have been filled. So again, that little fair value gap still remains to be, I suppose, penetrated. That's on the weekly. So weekly is bullish, but on the daily, came close to this. We had a resistance up here at 61.47. It hit it up there, but coming close to it there, so it may still possibly go there, but at the moment you'll notice the CCI is broken down into that moving average range, giving us a bearish signal, and the price has just touched that moving average with that wick. So far that was yesterday's trade, so the price has pulled back a bit. Nothing too dramatic to stress about or to panic, but at the moment, and you can see there's been a few fair value gaps, but they've all been filled with wicks of subsequent candles. There was a major fair value gap there that was quickly filled a few days later. But at the moment, we're looking predominantly at this CCI moving to the downside, and we'll wait for this price to break below that moving average to start taking short trades. Now, if we go to the intraday chart, so if you're trading on the intraday, the 1 hour or the 2 hour, etc., we look at the micro view. So again, predominantly taking, at the moment, you'll be starting to take short trades with that daily action. And at the moment, if you zoom in, you'll notice here the price and the CCI have broken below the moving averages, giving us a bearish signal. But do note, again, we've had a few fair value gaps there more recently in those few hours. and they were filled by those candles. And more recently, we've got this fair value gap hasn't been filled yet, and we may see the price retrace to the upside before possibly falling further to the downside. Now, we had a divergence here, a bearish divergence to that point that broke down, and if you continue there with those highs, so even if you continued that point to that high, that was still a lower high versus the same period on the price, higher high, so that's still a bearish divergence. That dropped as well. We take it, the next one would have been at that level, then finally at that level. So the way you read that is you keep tracing these bearish divergence until, and the trick is you wait for it to break significantly below these moving averages in the price. You can see there the price in that moving average band was still somewhat trending up, even though the price broke below it in those few instances, until such time it actually broke quite strongly and the moving average band started bending down like it did there. So what I'll do now is I'll demonstrate on the back test how you would have traded that if you're going long. So that is indicated by this period back here. So again, what we do, we've got the back test here for the stop loss approach and the average down approach, and you would have started taking long trades in that period around about the 27th of May when the CCI broke above the moving average band and the price was already above. So you would have started taking long trades on the hourly if you were trading the hourly based on the daily trend, and you would have stopped taking those trades more recently in the last couple of days, and I'll demonstrate how to get out of that. So up until that point, again, you would have taken the stop loss approach. You would have been in the deficit of about minus 400. The baseline's 100,000 there. And the average down approach, you'd be up in the total period about 5,800. And I'm not suggesting you let it run through the whole period. What you do is you, at the very latest, you want to close out your positions once the CCI moves into that moving average range. And that would have been somewhere in yesterday's trading, somewhere in this period here. So you would have got out of the trade at that point at the very latest. But to get out of the trades earlier, you've got to be aware of these bearish divergences, as I said, and you would have probably got out of the first one at that point there when the moving average band was trending down, and then started going long again during that period. But again, noticing these bearish divergence and the price moving averages, as soon as you started seeing the price break down with that moving average turning down, like in that area there, that's where you would have got out of the trades around that period there. So again, the stop loss approach would have been in the negative, but the average down approach would have been generating about $6,000 thereabouts if you had taken note of those bearish divergence. So the NASDAQ has a very similar pattern to the S&P. First on the monthly, we zoom in on the monthly there, and that's showing us we've still got a bearish divergence actually, even though the CCI is pulling towards that moving average range and the price is moving higher. But that divergence has already played out with that wick of that candle hitting its target. And again, similar to the S&P, we've got another fair value gap that hasn't been filled yet, and possibly one down here as well. So just be aware of that. I haven't marked that one. No one came down about 25% level of that fair value gap. But just be aware of that one. There could be an opportunity to see a decline down to that level. That's on the monthly. On the weekly, we had a very similar thing to the S&P. The price above the moving average is still heading higher along with the CCI. But again, notice these fair value gaps I've identified here. These ones back here were filled with the action of those candles, and all the others have been filled as well. And more recently, we had a bearish divergence versus high highs in the price, and it actually broke down. I haven't marked that one on the divergence, but you can see the pullback on that bearish divergence. That was a weekly. And on the daily, again, similar to the S&P, came close to this resistance. The CCI is actually broken into that moving average range, and the wick of that candle is touching that moving average range as well. So very likely going to see a pullback. And what we do now is we go to the intraday charts. But again, back here, notice we've got that wick came down to about 25% of that range, or that fair value gap. So we might see possibly the price pullback. And this green line here is actually a moving average. That's a moving average 200, simple moving average. So they could actually coincide with the price pulling back to that moving average, which also aligns with that fair value gap. So what I'll do, just as a market as a reference, we'll mark that fair value gap along with that moving average as a potential target area for a short position. So again, taking short positions on the intraday. Don't take short positions on the daily, because we want to make sure that the weekly breaks to the downside before taking positions on a lower time frame. So that's the general rule. Otherwise, you're taking a bit of a risk taking the trade on the one chart in isolation. So again, based on the daily, going to the intraday chart, the 1 hour chart, short positions only on the 1 hour based on the daily. You can see there the price is currently in that moving average range, and so is the CCI is broken just below it. Again, we've got another fair value gap, so we might see the price bounce initially before taking further downside. These fair value gaps have already been filled with those candles. So that's short positions primarily on the daily, based on the daily trend. But again, similar to the S&P, you would have taken long trades, just demonstrating the trading strategy. So these are the stop loss approach and the average down approach, and you would have taken long trades from around the 27th of May. And unlike the S&P, the stop loss approach in this case has actually returned a positive return, about $200, and the average down approach has generated about 3,200. But again, similar to the strategy of looking out for any divergence, you possibly would have taken, you're closing the trades during that little downtrend there after that bearish divergence, and you would have got back into trades once you start seeing the CCI and the price moving in alignment. And again, similar to the S&P, that moving average there was still trending up, even though it was wobbling a bit, and it finally broke down quite strongly, and you would have taken your trades, or you would have closed your trades around that period there on both the stop loss and the average down. But at the very latest, you would have got out of the trades based on the daily, somewhere in here, once the CCI turned into that moving average range on the daily. If you're new to trading, we're now including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. If you enjoy the content, subscribe at least on a free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. I'll be publishing on in this weekend as well. Thanks, and talk to you in our next video.